Welcome to this explainer. Let's cut right through the political noise, all right? Today, we're looking strictly at the cold, hard facts behind the complex 2026 federal budget changes to Australian property taxation, and more importantly, how they might actually affect you. Look, whether you're trying to buy your very first home, maybe manage an existing property portfolio, or you just want to understand the massive historic shifts happening in our economy right now, the rules of the game are absolutely changing. We're going to dive straight into the data and the modeling from top financial institutions to help you understand exactly what these new policies mean in the real world.
Here is our roadmap for today. We'll be covering 1. What negative gearing actually is. 2. The 2026 budget shakeup. 3. What counts as new. 4. The capital gains tax changes. 5. The market ripple effects. And finally, 6. The verdict for buyers. Let's get right into it.
Part 1. What is negative gearing? Let's lay the foundation.
Now, you probably already know this, but negative gearing, it's not some magic money tree. It's really just a tax mechanism to subsidize a holding loss today in the hope of making a bigger capital gain tomorrow. Simply put, when your property expenses are higher than the rent you collect, the Australian tax system has historically allowed you to deduct that loss against your regular income. And if the rent happens to cover the expenses, well, you're positively geared and generating a taxable profit. It's a foundational concept, and frankly, it's driven investor behavior in this country for decades.
To put that into perspective, let's look at some real-world numbers from Stanford Financial, because this really hits home. Say you buy a property for $650,000, and that results in a pre-tax annual loss of around $21,000. Well, the tax deduction doesn't just magically make that loss disappear. Even with the deduction, an investor in the 37% tax bracket is still bleeding roughly $255 out of pocket every single week just to hold that property. The investment only makes financial sense if the capital growth of the property outpaces that net holding cost over time.
Okay, this is where the data gets really fascinating. We constantly hear that this is just a tax break for the ultra-wealthy, right? Well, Treasury data tells a totally different story. Historically, out of the 1.9 million people earning rental income, 1.3 million reported a net rental loss. And here is the absolutely crucial detail. Nearly 70% of the individuals using negative gearing earn a taxable income of under $80,000 a year. It's not just for the top end of town, it's heavily embedded in the financial planning of everyday Australians.
Moving on to Part 2, the 2026 budget shakeup and the big policy shift.
Timing is everything here. The absolute critical moment to remember was 7:30 p.m. on the 12th of May 2026. If you purchased an established property before that exact minute, you're safe. You're completely under the old rules. But if you acquire an established dwelling after that, you are stepping into a whole new world. Because by the 1st of July 2027, the new negative gearing and capital gains tax rules take full effect.
So here's the massive shift, the real game changer. Pre-2026, pretty much everything was fair game for these tax benefits. Post-2027, negative gearing is strictly limited to new builds. If you buy an established home now, your rental losses are what they call quarantined. That means you can no longer deduct those losses against your regular salary. Instead, you're forced to carry those losses forward, and you can only offset them against future residential rental income or future capital gains from selling rental properties. Now, existing properties are grandfathered in to prevent a wave of forced sales, but for new buyers of established homes, the landscape has permanently changed.
Which brings us to Part 3. What actually counts as new? Let's decode the eligibility.
Since negative gearing is now locked strictly to new supply, figuring out what new actually means is the ultimate puzzle piece for future investors. According to analysis by William Buck, the government's goal is to genuinely add to the overall housing supply. So what makes the cut? Well, newly constructed apartments bought off the plan are in for sure. A knockdown rebuild where you've replaced a single house with a duplex, that's in because you're actively increasing the number of dwellings. Residential construction on vacant land definitely qualifies. And a newly built property that's been occupied for less than 12 months before being first sold also maintains its full tax benefits. On the flip side, what doesn't make the cut? Well, you can't just upgrade an existing footprint without adding an independent dwelling. So adding bedrooms or an extension to an established home doesn't count. A one-for-one knockdown rebuild where you just replace an old house with a nicer, newer house doesn't count because it doesn't increase housing density. Grandy flats adjacent to established homes are excluded too. And finally, if a newly built property has been occupied for more than 12 months before you buy it, it's legally considered established, and you lose out on the negative gearing benefits. Honestly, this dual system is going to be a massive headache for accountants. Investors now have this whole new compliance tightrope to walk. You literally have to track the exact purchase time down to the minute. You have to definitively categorize the property as established or a new build based on these really strict criteria.
And then you have to carefully calculate whether your rental losses are quarantined or immediately deductible. It is a massive shift in record-keeping and strategy for everyone involved.
Part 4. Capital gains tax changes and what it means for your after-tax return.
The second major reform hits the profit you make when you finally sell the property, and it completely changes the after-tax return profile. Previously, holding an asset for more than 12 months gave you a fixed 50% discount on your nominal capital gains. It was super simple and, frankly, highly lucrative during property booms. But under the post-2027 system, that flat discount is gone. The government is now using cost-based indexation, which essentially means they adjust your original purchase price for inflation and then apply a 30% minimum tax rate on the gain above that inflation. You are fundamentally being taxed directly on your real capital gain, not a discounted nominal gain.
But wait, here's the twist. Losing that flat 50% discount doesn't automatically mean you'll be paying more tax. According to Combank's economic analysis, if house prices rise only modestly, this new indexation model can actually work out in the investor's favor because you're only taxed on the gain above inflation. However, with inflation sitting at around 2.5%, once annual house price growth hits that 4.5 to 5% mark, the new rules become significantly less generous. The government is essentially curbing the massive tax windfalls investors used to enjoy during periods of explosive property price growth.
Section 5. Market Ripple Effects, diving into the economic forecast.
So, what does this all mean for everyday house prices? Well, taking all these changes into account, Combank's models project overall house prices to be approximately 3% lower than they otherwise would have been. Now, this impact won't be felt equally everywhere. It's expected to hit hardest in investor-dominated markets, think apartments, townhouses, and lower-priced established dwellings, rather than in the premium, owner-occupier detached housing markets. Now, interestingly enough, letting investors quarantine and carry forward those losses actually acted as a huge shock absorber for the market. If the government had completely scrapped negative gearing without that carry-forward buffer, Combank's models show property values would have dropped by a much sharper 5%. The quarantining mechanism acts as a critical safety net, softening the blow to property values to that -3% mark instead.
And what about renters? I know there's been a ton of debate about whether reducing tax incentives for investors is going to cause rents to just skyrocket because of a lack of supply. But despite those concerns, Treasury estimates the impact on rents will actually be incredibly muted. Because negative gearing is being preserved, just redirected toward new construction, overall housing supply shouldn't collapse. As a result, they're projecting a very gradual increase in rent of just $2 per week for the median household.
This creates a really fascinating dilemma, summed up perfectly by CBA's senior economist Trent Saunders. Because existing investment properties are grandfathered under the old, way more generous tax rules, current owners have a massive incentive to simply never sell. If they sell, they lose the tax break forever. Now, this definitely reduces the risk of panic selling and market crashes for sure, but it creates a profound lock-in effect. Current owners will stubbornly hold on to their tax-advantaged assets, which is going to reduce overall market turnover and limit the number of available listings.
Finally, Part 6. The verdict for buyers. How do we navigate this new landscape?
Pulling this all together, what does this actually mean for you, the everyday buyer? While first home buyers will undeniably face way less competition from investors when bidding on established, older homes, and that is a huge win for affordability. However, because of that lock-in effect we just talked about, the resulting drop in housing turnover means there will simply be fewer established homes put up for sale in the first place. So finding the right property might actually become harder, which kind of dilutes some of those affordability gains. Meanwhile, capital and investor demand is being forcefully redirected into new construction, which the government is really banking on to help us build our way out of the supply shortage.
Let's leave you with this final thought. The 2026 budget is arguably the most significant shift in property tax policy in a generation. It attempts this incredibly delicate balancing act, cooling investor demand for existing homes without crashing prices and boosting new supply without sparking skyrocketing rents. But as the dust settles on these historic reforms, we really have to ask ourselves, will tweaking the tax settings genuinely solve the underlying structural housing supply crisis in this country? Or has the budget simply changed the rules of the game, creating just a brand new puzzle for buyers and investors to solve? Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and I'll catch you next time.